So today we want to talk about the exit tax and grantor trust. Now, as part of our practice, we deal with quite a few individuals who are giving up a U.S. passport or a U.S. green card. Now, under certain circumstances, they may trigger covered expat status, and as a result, they'll be subject to the exit tax. Now, we've covered the exit tax in a number of other videos, as well as on our website. We have quite a few articles which go into considerable detail. But today we want to talk about how is the exit tax calculation impacted when there's a grantor trust involved. In a way, it's relatively straightforward. All of the assets in the trust of which the grantor is considered to be the beneficial owner need to be considered in that exit tax calculation. Now, when you look at the statutory language, it's not very clear. The statutory language refers to all property of a covered expat. Not very clear, is it? Now, the Joint Committee on Taxation's commentary to the Hart Act makes it pretty clear. Now, let's look at it from a different perspective. What if there's the outward migration of the grantor trust itself? Now, under that circumstance, it can also trigger an exit tax to the extent that there should be gain recognition. You see under Section 684, the outbound migration of a U.S. grantor trust may trigger gain recognition, but not loss recognition. So you'd need to recognize the gain, but not the losses on the trust assets. Of course, this only applies if the trust ceases to be a grantor trust and becomes a non-grantor trust after the outbound migration. Now, to bring that together with the exit tax of the individual relinquishing their residency or citizenship, if there is gain recognized on the outbound migration of the grantor trust, then that gain is not going to be again included in the exit tax calculation for the individual. You're not going to be taxed twice on the same assets.